Welcome to the course on what is a stock option. In my introduction course, I'm going to tell you real quick basically what this is and isn't. This is not for advanced traders. This is for beginners, someone who does not know what a stock option is. I'm going to try and tell you what it is pretty quickly and explain how they're valued, how people trade them for the most part, or at least what factors are taken into that. I have another course that goes over more in depth of which method I like to trade. So with that, we'll go ahead and get started, and I want to tell you what I trade, or this is what I trade most at least, is the Standard & Poor's 500, or the S&P 500. More directly, I trade an exchange-traded fund called the SPY, or at least that's the symbol for it. It has a really good track record, as you can see, notwithstanding the crashes, but everyone was affected by those. I post charts of the SPY daily on my Instagram. I'll leave a link for that, or you can just see it in Udemy. Now, the S&P 500 does really well a lot of the time. It's not just me saying this. I could show you article after article, and I've seen it and heard it time after time, basically saying how well this thing does over time. It beats almost everyone. There are exceptions, obviously, but they are the exception, not the rule. So instead of trying to beat it, I just joined them. The SPX is the main index itself. It's somewhere in the 2,000, 2,500s right now. The SPY is in the 200s, so it's a fraction of the S&P 500. So it's easier to trade and easier to get into. Also, there is another one I used to trade, the Russell 2000, also with its ETF of IWM, and the main one being the RUT. It's a lesser known one, smaller cap stocks, and I'm sure you've probably heard of the Dow Jones Industrial Average, DJIA, and also at least one of the ETFs for that is DIA. I liked that one. So a lot of options. I still stick with the S&P 500, but I wanted to tell you what I trade, not just tell you basically what options are. That is for the next course. So as always, don't look for a fair fight. Okay, on to options. What is a stock option? If you're already familiar with stock options, you can probably go through this once or just skip it. If you're new to options, you might come to find out, even if you have to go over this a few times to get the concept, it's not as confusing as most financial things seem to be. It seems like the financial world seems to make things sound more complicated, probably just to use their services. But a stock option is simply a contract. There are two types, ones that act like coupons and the other ones that act like insurance or a warranty. And each one has a price and an expiration date, two characteristics. So there's two types and there's two characteristics on each. But basically when it comes down to it, it's like any other contract. Like a coupon or a call option, it's meant so that you can buy something and hopefully cheaper than it would be later sometime in the future. And then there's the put option, which acts like insurance or warranty, where something might drop in value and you still get to retain that value. I'm going to try and go over some examples, but that's really at its core, they're just that simple. I'm going to go over a chart here. I just grabbed one. I like when possible to use a practical chart, not just some perfect jigsaw line graph drawn out to make it look like it always goes perfectly. Like I said, they're coupons and insurance. So if this were to represent the upcoming year, like if we're starting all the way over there to the left, what we could do is if you expected it to go up, which obviously it doesn't until close to a year away, you could buy a call option and you would be allowed to buy at the 120 mark if this is exactly where you bought the stock or bought the option, or you could buy also a put option to protect yourself. And in this following example, this is probably what you would have wanted more than a call option. I go into more of the strategy of setting these up later. I just want to make sure you understand what it can do, or what options can do for either stock position. If it were to go down, like it did here, you would be able to buy the stock at the 120 where you bought a put option. Okay, so exercising, as they say, a put option contract, Some people actually call them options contracts because that's all they are. It would allow you, even though the price is closer to 110, currently it would allow you to sell it at whatever strike price you specified. In this case, it being at the 120. So even though it's at 110, you still have the right because you have a contract saying you can sell at 120. Now, obviously, if you had bought the call options, they'd be worth less than they were before because the stock went down. Okay, I'm just trying to explain both of them at both steps. So at the second arrow, at right around the 110 would be a great time to buy a call option, because when it continues to go up back up to the 120, as you see it does, you would be able to buy this stock at around 110 or whatever strike price you had set, even though the price is at 120. So this could be done at any one of these steps, and obviously the trick is knowing when to do it. The method will cover more of what to set these up for, but I also want to give you a look at an options chain. If you're to go to Yahoo or MarketWatch to look at stock options, this is what they're going to look like. And I just kind of want you to get familiar with it to demystify it so it's not too confusing. On the left, we have the call options. Remember, they act like coupons. They allow you to buy stock. On the right, you have put options that are the contracts that allow you to sell a stock. Right up at the top is one of the two characteristics: how long they last, its expiration date. Like any warranty and most coupons, even manufacturer coupons that last like a year, they expire. You can't get an unending contract. So you specify how far out you want them, and then you down the middle is they're stacked by the strike price. Now, if you notice, the price goes up even as you move down the screen. I'm not sure why this one did it that way, but it's how you categorize them. The calls over to the left are that correspond with the strike price. Like I said, this is just to try and familiarize yourself so they don't look so obnoxious. As you can see, just to the left and the right of the strike price, you have bid and ask prices. And this is like any online auction. You have something that somebody's asking for, and then you have the current bid of what somebody wants to buy for. And the difference between them is called the spread. And normally, you want this as narrow as possible. You want them very close together. Okay, that's another term called liquidity. If the gap between the bid and ask is very wide, it is called illiquid. And if it's very close, it's liquid. It's that simple. But when you want to trade something, you want it liquid because you want to be able to get in close to the same price you get out. It'll make more sense as we go, but I wanted to make sure that it was at least covered. I'm going to go back to the other screen real quick and point out, I want to go over the time frame, because the value of the options will depend on its two characteristics. So what will determine an option's value or price when you buy it or when you sell one is the two things that determine it are how close the stock is to the strike price that you're looking at, and also how far out the option will go. Now, if you look at the months down at the bottom, each little square is 1 month. And if you're looking at put options and you want to protect yourself from loss, which, looking at this chart, obviously that's probably what we'd be more concerned with, especially if we're starting over there at the left. So if you were looking at this and you just wanted to hold it and you're buying a put option, you'd want to make sure that you're protected. Now, obviously, to protect against the whole downward movement, you'd need an option that's at least 3 months old or 2 months. So you would need it that far out. Now, if you wanted to protect yourself all throughout the year, all the way over to the right, the option would be much more expensive than just a few months out because you're paying for more time. Now, also, if we're all the way over at the left again at the 120, and you didn't want to buy too inexpensive an option either, and you still wanted it far out, like the whole year, but you wanted it a little bit cheaper, you could buy the 115, which would give you a little bit of room. It would be cheaper than the 120 because it's farther away from where it is at the top left. So basically, those two things will determine its value. Where the price is in correlation to whatever stock you've selected and how far out. So basically, if it's like with the insurance metaphor, if you want more insurance, if you want full coverage on your car, it's going to cost more. And if you want the extended warranty, it's going to cost more. Both scenarios. So, and that one's a little more easier to explain, since there's, I think, a more direct correlation with insurance than there would be a coupon, since most of the time you don't really pay for coupons. They just give them out to incentivize you to buy. So, but with insurance and warranties, it suits it a lot more because it makes more sense. Do you want more coverage? Do you want to, to protect more, and how far out do you want to protect? So, obviously, I point at these three moments because they're obvious dips, but it's never really that clean, and I don't like it when people try and paint, oh, well, you just need to know it's here. The thing is that this is still a good example because at the $5 marks are good round numbers, and things tend to, I'll explain more about support and resistance later, but these tend to stick around these and bounce off these lines even to some degree, even over to the right where it does drop below 105. They're nice round numbers, and you can protect yourself at different points. Like if you had only, in the first month, if you had only bought an option a month out and a put option, it would have been a good investment because it did drop the full $5. And so if you had bought the 115 put option, or excuse me, if you had bought the 120 put option, and when it went to 115, you'd still be able to sell your stock at 120, and that whole month went the distance. So in short, I hope that clears it up a little bit or adds to it. Every option has two characteristics, and there are two types, the calls and the puts, and basically they act like insurance and coupons. I hope that clears it up. If not, rewatch this or send me a message.
Okay, I wanted to cover one more thing about what is a stock option. I wanted to cover the value just a little bit more to make sure you had a full understanding. And forgive me for using the same slides. But basically, with the two characteristics of a stock option being what the price is, the strike price, and how far out it goes, its expiration date, both contribute to its value. First off, the further out it is, the more valuable it is. It's just like the insurance or the coupon. If you have something that expires this month, it doesn't have a lot of value. You have to act on it quickly. But if you have a warranty that lasts 5 years, it's obviously got a lot of value because it's protecting you for longer. So the first characteristic, time, and how far out it is, expresses part of its value. So the further out it is, the more valuable it is. That one's a little more simpler. Because there's the two types that allow you to buy and sell, the correlation to where the strike price is to where it's currently trading is what determines its other value. If we're starting right over there to the left, a option placed wouldn't be very helpful over here, alright, because throughout this it doesn't go up much. So the put option placed right there at the money would be very valuable. But if at the left position you bought one over here, it would be cheaper than if it was closer to what they call at the money, right around the 120 mark. Okay? Sorry if this gets confusing, but basically, if you, tell you what, we'll just go through and actually look at this. But looking at all the positions here, you can actually see that the value of them goes up and down. The top left are the in-the-money call options. Now, if you look down the center, the strike prices, as they go upwards towards the top of the screen, the number is going down. It's a little backwards, but you see that in-the-money call options are the ones that allow you to buy. Okay, so this means that the cheaper you can buy them right now, or you can buy them cheaper than it's trading right now, which means they're in the money. So if it's trading at 209.50 and above it would be the 210, if you see the how it goes from blue to white, if it's there and you can buy at 205, obviously that gives you more value. And if you look just to the left of the strike price is the bid, ask, and the last. The last is the last thing it traded at when I took the screenshot. And if you can see just down the whole column of the last, at the very bottom down in the white it's at 125, and up towards the top it's 629. That's where the value is. The deeper in the money it is, the more value it has. And like I said, the more delta it has. And conversely, on the other side, they have also a bid, ask, and last price. And the in the money options on the put are on the reverse, because that means you can sell them for higher than what they're currently trading. Okay, hopefully that makes it more clear. Given everything I said, you want to keep in mind these two values. A lot of people will buy only the cheap options, and they have a low delta, and they're kind of like lotto tickets. They don't have a high probability, and they don't have a lot of movement. So you have to be careful, but the deep in the money options would be the ones that had the most value and would move the most, both considering delta and further out. So the further out they have, the delta increases as well, and that means they have more value. I hope this cleared it up some. I just wanted to make sure I fully covered how they're valued. I didn't want you to miss out on that. So one last thing to your knowledge base. Once again, don't look for a fair fight. Okay, continuing on with our course here. There's something that's a little more advanced that I want to go over, that I think it's important that you understand, even though it can be a little confusing. So we're just going to go ahead and continue forward. And this is going to be an option Greek. Okay, there are several Greeks. I've been trading for several years, and I probably couldn't tell you all of them. But basically, they're vital to understand how options work. There's several of them, and they all do different things. There's theta, there's gamma, but the one we're going over today is delta. One of the main reasons why people get into options is because they're leveraged, so to speak, and that combined with the fact that, at least in the American stock market, you have to buy them in packs of 100, the price can move a lot faster than the stock itself that it's tied to. And for this reason, people think that they can make money faster, and they can. However, you can lose money just as fast. However, also, some options will move faster than others within a specific stock, and it's based on delta. And delta is a number 0 to 100 or 1 to 100. I don't remember if it actually goes to 0. And it's like a percentage. The best way to think of it is a percentage move. And what the percentage is, if the stock moves up $1, if each option moves up $1, then its delta is 100. And if it only moves up half as much, it'd be 50. Okay, so it's like a percentage move. The trick to it is that the further inside the money and the more value an option has, the higher the delta will be. With this picture, I'm going to show you the bottom right and the top left are the in the money options. This snapshot was taken when I guess it was in between 209 and 210. Now, the in the money options will have a higher delta, but also moving further out in time will also increase the delta. So the deeper in the money and the further out, the higher the delta will be. So choosing the cheap options of out of the money and closer to the expiration will have a lower delta. It's kind of a combined risk-reward thing. The further in the money, the more expensive, but also the higher delta. And the further out in time, the same thing. It'll be higher in value and more expensive. So, as always, more risk, more reward. It can be a little much to take in. Like I said, they're literally called the Greeks. You know, if somebody's talking Greek, it can be kind of confusing. I did want to show you this one tool on my website. I've got an options calculator. You can put in strike price and the option itself to look up delta, and it gives several other option Greeks, delta, gamma, theta, vega. To cover briefly, once you get the idea and the concept of delta down, what you want to learn also is theta. That's the other Greek that I really focus on, and that's because in my favorite method, covered in the other course, and how I actually specifically trade and how I like selling options more than buying options. It's more complicated than that. It's a great method. I highly recommend you check it out. I'm going to leave some coupons at the end of this course for that course. Now that you have a basic understanding of one of the Greeks, delta, you can go forward with your option trading a little wiser than you were before. As always, don't look for a fair fight. Okay, on to technical indicators.
What I want to go over in this course is just obviously technical indicators. What these are going to be for are for setting up your trading plan, which is a required step. You have to know when you're going to get in, and more importantly, when you're going to get out, take profits, or hopefully get out at a minimal of loss, because it does happen. So we'll get started. Technical indicators help you open and close trades. First up is Bollinger Band. These are very mathematically advanced and very cool, but if you don't like math, it's fine. They're very visual. They wrap around. I'll show you a picture. I did read the entire book of Bollinger Bands from the guy who created it, John Bollinger. It was a little dry for me. It's like I said, it's very math intensive. Thankfully, the types of ways he recommends trading with the Bollinger Bands are on his site from his book verbatim, and I believe he's added one or more ways to trade since publishing it. I don't know if he's republished the book or not, but it's on his website for you to read, and it's specifically just the way he trades, at least last I checked. Alright, another really awesome one, the MACD, or Moving Average Convergence Divergence. Or, obviously, I like calling it the MACD because it's a lot easier. This one is really great. It gets you to where you can see the trend, and more specifically, when the trend is changing. So it's good to know when to, hey, it's starting an up move or an uptrend, or hey, it's ending the uptrend and you need to get out, or vice versa. Like I said, options lets you trade up or down a lot easier than shorting a stock. So support and resistance, these are really key, and they're really simple, almost absurdly so. There's no actual fancy line. It's the imaginary lines that you draw, or sometimes the rounded off price numbers. These are very simple. A lot of traders, especially ones that trade in higher frequency, like day traders, will do or use almost exclusively. And the RSI, the Relative Strength Index. I really like this one, but I've never really fully incorporated it into my trading style or my trading rules, but I could see how you could, and I'll show you what that looks like as well. Simple moving averages, these are probably a lot more my speed. They're an average. You just take the numbers the same way you do an average in math class, or as I always do on a calculator, how many ever days in a row you want to average together. These are really, really handy. Okay, first off, to look at Bollinger Bands, like I said, they're very visual. For the most part, in most defaults, the center line is like the 20-day simple moving average. Now, the outer lines are calculated by both the volatility and just price movement. Like I said, I could, the book covers it more in depth than I could. If you want the details, great, read the book. If not, you kind of get a feel for how a stock is moving. And if you look, what I also like is that when it moves up or down, like all three lines together, and kind of points in the direction it's going, but it can jump outside the outer bands. It doesn't frequently do that, and so it's kind of giving you the width or breadth of this. So it gives you kind of what to go on. Okay, and on to the moving average convergence type, blah blah blah. Okay, MACD. All right, it's not on the top, and I apologize. At the top, I kept on both the Bollinger Bands and two simple moving averages. Down towards the bottom, it's a lower overlay. Now, there's two ways you can read this. There's the two single lines that intersect, and then there's the green based around the zero line. And either one can be the same thing, because when the two single lines cross, it's the same thing as when the green line crosses the zero line, and that is your change in direction or trend. So when it crosses the zero line towards the top, then that's starting an uptrend, and vice versa. When it starts down, it crosses below the zero line. Now, if you notice, I'm glad I got a real screenshot of this, because if you notice over to the left, like the later half of June, it kind of goes back and forth and doesn't really do much. So every cross, you don't necessarily want to get in or out at that same time. So you kind of want rules around this. Or if you just want to say, all right, I will get in when it says it's going up, I will get out when it stops going up and it's going to go down. So you just want to develop your own rules, whatever you're comfortable with. This is all about your risk tolerance and what you can handle, how aggressive or conservative your trading plan needs to be. Support and resistance are very simple. They are just lines where people bounce off the top or bounce off the bottom. If it's got support, that means people don't want to sell too low. If it's got resistance, people don't want to buy it too high. It's pretty straightforward. Here I grabbed an actual chart because I don't always like the ones drawn out because it makes it look a lot simpler. If you look, and over to the left, if you see to the far left, even in before November, what was a resistance line after being crossed becomes a new support. And that happens a lot, and that's why why support and resistance is really popular. But basically, it's just the lines drawn. It's like, okay, if nobody's gone that high before, it's a resistance. If it's bouncing off a line, it's support, on the bottom. So it's very handy and very simplistic, so it's a lot of people really like. RSI, Relative Strength Index. Also, like the MACD, it's down at the bottom. And I like this one because it even says it. It says, well, at least on E-Trade, it has the overbought and oversold. So each line is a significant point of crossing over, but I like how it just says, hey, too many people are buying this, it's going to bounce back. Or if it's oversold, it's going to bounce either way. So, like I said, I've never incorporated this into my rules for trading, but I always liked it, and it helped give me an idea of which way the market is moving. Okay, simple moving averages. There are different versions of this, but the simple moving average is just the straight up average. Here lately I've been kind of liking the exponential moving average where it gives more weight to the current moves, but these are the simple averages, and just looking at this I can see plans come together in my head. Like in my mind I always think, okay, well if it's above the 20 and 50-day moving average, then I should be in. Like if it's above both of them. And more specifically, if you look look at February, at the beginning of the month, it jumps up above the 20-day moving average. 50-day moving average, it jumps up above that as well, but the 50-day moving average is already above the 20-day, so it's kind of bouncing back up. You may want to have the rule to where you only get in like that halfway point when all of them are aligned, where the 20-day moving average line is above the 50-day moving average and the 50-day moving average is above the 100-day moving average. So, and then a good point to get out would probably be when the stock itself touches or crosses the 20-day moving average there at the beginning of March. So make sure you have good exit points. It's just as important, if not more important, than when to get in. And that is technical indicators, at least in a nutshell, to get started. As always, don't look for a fair fight. Okay, I have one more thing here I just want to add. It's not anything directly to do with stock options. I've already gone over what a stock option is, how it's valued, and some characteristics that are really important. This I just find is like too valuable to not include in anything stock market related. It's something I found in this book, The Stock Trader's Almanac. This is the 2015, but they make one every year. I'm not the magic. I didn't figure this out. I found this book, and it has a lot of information. It's a really great book. I recommend it. Obviously, probably the more recent ones would be better. This one's obviously only 2 years old. There is a 6-month cycle. This is one of the many things it goes over. Like I said, it's a wealth of information, but this one thing more than any other I wanted to add so that you knew. And if you already knew what it was, then you probably weren't a novice. From November 1st to April 30th, is the good 6 months of the Dow Jones Industrial Average. There's the two different 6 months. There's the good or strong 6 months, and then there's the May 1st to 31st, or October 31st, weak 6 months. And I would say this is not necessarily always weak, but less predictable. There are several years where the 6 months, it just keeps going strong. So I would say it's more of less predictable. So don't count on it specifically going down after that time. You might have heard this in a phrase called sell in May and go away. And here's the straight up numbers. I think this one was pulled from a different one. This is just an infographic I got. This is the 2012 one. Okay, if you look at this, if you start with $10,000, okay, now this is just the numbers. Obviously, if you also check the year, it's 1950. None of us can probably start with $10,000 in 1950, but it's just to show you the numbers and how this cycle works. If you were to just invest in the bad months, you'd be down $1,024. And strictly by the day, just November 1st, April 30th, and then May 1st to October 31st. And if you had invested in the good 6 months, you'd be up over $500,000 and then some. So it goes to show you statistically how these months do. This cycle is still alive today. They still run the numbers on these current ones. So including a really important point is in 2008 when it crashed. If you look here, that is May 1st highlighted. It was not a good year in 2008. It may not look like this, look like very bad from this perspective, but it was not a good 6 months. And that in itself can be a pattern or a telltale sign that it's having problems, because during the time it's supposed to historically be strong, it was losing, and losing bad. If you see that first dive down in January, that was bad, really bad. It had basically undone like 2 years of growth. If you look at that from 2007 to 2008 and then half of 2006, the latter half, it had undone that. So it was bad already, but then just by October, it had just been obliterated. That was when the full-on crash. But also, if you look at 2009, it just bounced right back. After it's like the third month in before it started doing it. But and this is why, even though the job market may not be the same, the stock market can help you rebound. And that's why nobody cares more about your money than you, and you should look into these things. Okay, here's a different graph. This is the same numbers on the left, updated. It's a more current numbers, but also this is using an indicator, the MACD, or moving average convergence divergence. It's kind of a mouthful, but this is to help the timing of it. And if you were to use this pattern, this good 6 months of the Dow, the seasonality, combined with the MACD, it adds a lot of weight and strength to this whole pattern of trading. So on the left, it is just the dates by themselves. May 1st, October 31st being the bad 6 months. If you had just invested those, you'd be down $379. And then November 1st, April 30th, you'd be up still over $500,000. Now, using the MACD, you would be down $6,383 using the MACD as a timing for the 6 months. And you'd be up over $1.5 million on the good 6 months. So using that indicator with that gives it a lot of strength and a lot more leverage. So I just wanted to cover these. It is important that you don't strictly try to trade by this, and maybe more specifically the bad 6 months, because I've made some bad trades and lost more than I'd like to admit, thinking, oh, it's the bad 6 months, it's going to go down so I can take a bearish position. That's not really it. It's a cycle. Don't count on it just shooting to the moon on November 1st. It is just a cycle. Like I said, that is balanced over time. So, but it's a very powerful pattern that repeats a lot of the time. Like I said, it's most of the time. It's an average. So just use that going forward. And as always, don't look for a fair fight.
Okay, and to wrap things up, this is the final lecture in this course. I wanted to get right into it. You need to trade smart. More logic, less emotion. You need to trade as mechanically as possible. You'll have to set up your rules. Keep a journal. I hate that I'm saying those just really fast, but those are very, very key. Several books have cited those as being the biggest difference in amateur traders or professional traders. Keep a plan. Keep a trading journal of some kind. It's really can't be overstated.